Hello, I'm Jeremy Allaire, and this is The Money Movement, a show where we explore the issues and ideas in this brave new world of digital currency and blockchains. So it was another really busy week in crypto and stablecoin land. USDC crossed over 3 billion in circulation. Circle launched a major upgrade to our suite of payments and treasury infrastructure for the internet. And there's been a lot of regulatory rumblings, if not regulatory heat. We're feeling it. We may be about to see a regulatory sledgehammer brought down on crypto in the United States by departing Treasury Secretary Mnuchin. So I want to dive into this. I want to break down what's going on and share some perspective on this. I'm going to start with some really basic stuff here. The first is just, when we look at crypto and we look at blockchains, we're looking at the core a very, very fundamental innovation, an innovation that has, I believe, far-reaching consequences, much more far-reaching than even the web itself. And this innovation of public blockchains represents fundamentally a new infrastructure layer for the internet. It's an infrastructure layer that allows for counterparties around the world to have an incontrovertible set of record keeping, a way to transaction process or to conduct transactions, and a way to deploy code. These blockchains are like a new computing layer for the internet, designed to accommodate economic activity. And it's their public, open, permissionless nature, like the internet itself, which makes them so transformative. And the uses of this technology obviously start with things like the new forms of commodity money that underlie and secure these decentralized networks like Bitcoin and Ether. But the uses expand far, far beyond into really every category of record-keeping industry in the world, every dimension of finance, but increasingly with the improvements we're seeing in blockchain technology, offer the potential to decentralize fundamental services like communications applications, social media applications. So many of the things that regulators are frankly looking to break up Facebook around, we can rebuild in a decentralized architecture on this infrastructure. Now, a lot of the attention on this show and in the industry is around the role of crypto and stablecoins and the like in this sort of world of value exchange. So a fundamental premise here is that on these public networks, on these permissionless networks, it's becoming possible to exchange value instantly, globally, the speed of the internet, with much higher levels of security, privacy, and resiliency versus fraud than our existing financial system can present. On top of that underlying kind of commoditization of value exchange is this new layer, this layer of programmability, the ability to create contracts, the ability to create financial protocols that operate entirely on these public networks. We're seeing that in the growth of borrowing and lending markets on the internet, decentralized finance. We're seeing many of the building block primitives of how capital works in the world being built on this infrastructure. This creates an opportunity ultimately for billions of people to access financial services in ways that haven't been possible before. So a major innovation. Now, also at the core of this infrastructure is the role that this technology can play in providing greater degrees of security, greater degrees of privacy than had been made possible with the existing financial system. Underlying crypto is this concept of a digital asset that is in fact a bearer asset. and that individuals have the ability to hold these bearer assets independent of the state. Non-sovereign stores of value, non-sovereign money. This underlies the tremendous interest in Bitcoin. Even from, I think now at this point, pretty much any major macro investor has a strong thesis that the dollar and other fiat currencies, have challenges, and that from a risk management perspective, holding these crypto bearer assets as a hedge against what's taking place in the world economy is not only rational, but potentially very desirable. So there's this underlying component that exists here as well. On the whole, this represents public chains, these digital assets, the ability to have these public global protocols, in my view, is just an enormous human innovation that ultimately allows for radically greater financial inclusion, greater economic integration of entities, businesses, and nation states even, breakthroughs in commerce and trade, business models, and frankly, the potential to return trillions of dollars in value that is captured by intermediary banks and other ecosystem participants in the existing financial system, to return that capital into productive use for society. Now, we all know from the last 20 or 30 years that the open internet makes it easier for bad actors to operate. We know this, it's everywhere. Cyber attacks, data breaches, hackers, terrorists posting videos online, recruiting and operating using encrypted messaging apps. All of this is apparent, and we know this. And at the same time, as a society, we are not willing to sacrifice the open internet on that basis alone. We are not willing to provide complete government control and boundaries on the internet just on the basis of bad actors operating. And in fact, the really key thing is that law enforcement, national security apparatus, governments have adapted themselves and have built better and better tools. Now, in this space, in this world of this new open internet of finance, we know the same thing exists. We know that bad actors are operating. There's lots of data about this. There's lots of firms that analyze this. And of course, the firms that are intermediaries between the existing financial system and crypto and blockchain constantly work with law enforcement, constantly work to thwart that. That is part of our obligation. We also need to build new tools. We need to build new tools for an open internet of money. And collectively, as an industry, it's incumbent on us to build better and better tools that meet those needs. But at the same time, preserving and protecting the innovation of public internet infrastructure and public blockchain infrastructure in terms of finance. So I think what we're seeing now is that this concern over criminal abuse is significant. And this is where the regulatory hammer is being focused. But the approach, which is I believe, a short-sighted, simplistic approach based on what we're hearing, is likely to do enormous damage to a highly innovative sector. Now, for those that aren't familiar with this, all of this has sort of gradually bubbled up to the global level over the past years. The international body that is responsible for the rules around anti-money laundering on a global basis, the Financial Action Task Force, in 2019, put in place new rules around firms in the digital currency ecosystem needing to have controls in place to be able to collect appropriate information on customers, share that information appropriately. And that's led to a great deal of industry work that's going to roll out over the course of 2021, the so-called travel rule. These issues have become even more exacerbated and greater interest on these with the growth in Bitcoin, with the growth in stablecoins like USDC, and with the proposed launch of Diem, aka Libra. And that's led to finance ministers from the G7, finance ministers and other key stakeholders at the G20 to really look at, is there more that they want to do to regulate this? So the kind of question people naturally ask is why now? Why now is because crypto is going mainstream. Bitcoin is going mainstream. Major technology firms are launching digital currency initiatives. We're seeing this industry grow up very fast. We're seeing stablecoins like USDC on the verge of being components, mainstream components of what the payment system can be. When we look at why now, however, I think some of this is very specific to agendas that exist. I think when we look at Treasury Secretary Mnuchin, and I've listened to him speak on this topic multiple times, he's got a bee in his bonnet about self-sovereign digital assets. He'll say Bitcoin is fine. He'll basically say it's fine, but he thinks it's stupid. But if you want to own it, you can go ahead and own it. He would essentially say stablecoins are fine. If financial institutions are issuing these, they're fully reserved. But unhosted wallets, we cannot allow people to have secret Swiss bank accounts in their pocket. And those are his words. So this is the core issue. And I think in all of the work on anti-money laundering, countering terrorism finance, the industry has tried to preserve this interaction with self-hosted wallets. It's a core component. It's one of the foundational components of a public blockchain, of a permissionless blockchain. It's core to the innovation of smart contracts and decentralized finance, the ability for an individual to participate in a financial protocol on the public internet. And any regulatory approach to this fact that software can exist that provides self-sovereign access to digital assets, any regulatory approach to this, it seems, is now likely to be delivered with a sledgehammer approach rather than what needs to be delivered, which is to consider this with precision tools. So this is exactly what appears to be happening as we speak. So earlier this fall, FinCEN, the Financial Crimes Enforcement Network, which is a department within the US Treasury Department, issued a new proposed interim rule. Now, this interim rule was about tightening up travel rule definitions in a sense, and thresholds. So specifically, this interim rule was proposed, and it was essentially to say all crypto assets are included in the definitions of money, and lowering the thresholds for transactions where all of this personal identity information needs to be exchanged to $250 transactions. And most crucially, it imposed it on domestic transactions, not just international transactions. And this specific interim rule went out for public comment, and it's been deeply opposed by the industry. It places an unfair burden, an even larger burden on digital currency firms that go above and beyond even what domestic banks must do. Now, additionally, so we've had that proposed rule, and additionally, in the background, we've seen apparent coordination of the finance ministers of the G7 who met this week and appeared to come to a consensus that they want to go further. And the kinds of restrictions that Mnuchin has wanted to put in place are even tougher. And apparently, these restrictions have been jammed into this new interim rule around interactions with unhosted wallets. Now, this isn't final and we haven't seen it. And a lot of the uproar and a lot of the attention and the letters from Congress people, industry leaders, and others are focused on this, because if this happens, it has a massive impact. No one has seen the language, and it's being added at the last minute before this interim rule becomes law, and the consequences are enormous. In our view, however, jamming this in at the last minute is a total breach of responsible conduct, with a period needed for congressional review, a period needed with these refinements for public comment and review, something that is so core and fundamental to the core benefits of public blockchain infrastructure. This kind of rule will undermine the premise and promise of financial inclusion and open access and radically limit the potential for innovation in decentralized finance. And frankly, this would continue to make the United States one of the least receptive countries in the world for the blockchain industry. So what's really at stake here? What's really going on for these various finance ministers? What are the real motivations here? Is this purely about, hey, we've got to have tighter restrictions on financial crimes enforcement? Or is there something else? It's interesting. The public quote from the German finance minister, Olaf Scholz, he said, "We must do everything possible to make sure the currency monopoly remains in the hands of states." So maybe this is about something else. Maybe this is about an attempt to stem the tide, to plug the hole in the dam around what's happening with digital assets in the world. The motivations are not squarely focused. There may be justifications, but clearly a completely different level of standard being applied to this industry. There appear to be other motivations. So this is in the same week that the Financial Times published a piece about the inevitable rise of Bitcoin in the face of profligate money creation. The piece asserts that the legitimate rise of Bitcoin is happening as an alternative reserve currency. And it actually ends with an interesting note. Now, this was an opinion piece, but it ends with an interesting note. It says, "And stepping in to regulate the digital currency boom, as some governments are already considering, may only accelerate this populist revolt." The point here is that individuals, investors, institutions want to build on and depend on digital currency and digital assets. And this challenges the nature of governance in the financial system. And this is significant. And it'll be interesting to see how people respond. Now, obviously, there's an incredible amount at stake for our industry. And the question is ultimately, what should be done? And there are ways to solve for the issues and risks that are purportedly being considered here. In fact, the existing system of anti-money laundering and countering terrorism finance is broken and doesn't work. We know the data. There's $2 trillion laundered per year with US dollars. By the standards of leading financial crimes enforcement agencies globally, and others estimate that 98% of money laundering in the existing banking system goes undetected. So clearly, we don't have a system that works. But the solution to this problem, the ultimate solution to this problem, lies within public blockchain infrastructure itself. The only way to address the deep financial crime risks are by building on open, public, tamper-resistant, uncensorable global systems of record keeping. And by building on that infrastructure, which is a breakthrough infrastructure, we can build identity protocols. We can build those identity protocols on the very same public blockchain infrastructure that we're building these new forms of money and payment systems. And identity protocols that are built on this can preserve privacy. And in fact, they can preserve privacy using crypto in a way that is far superior to the existing financial system, which is prone to an enormous amount of cyber attacks, data breaches, and violations of PII that's on a constant basis. It can do this in a way that allows individuals and institutions to use open networks, to use permissionless networks, to use decentralized finance services and protocols, and this broad array of other decentralized services that are being built on blockchains, whether this is in the world of content or communications or record keeping in other forms. An identity protocol that is open, self-sovereign, and decentralized can build a model of identity issuers. Identity issuers can be governments. Identity issuers can be financial institutions. And these identity issuers can offer identity attestations that allows know your customer to become know your transaction. And in so doing this, still keep the vast majority of the benefits of decentralized protocols while preserving privacy and still enabling law enforcement to do their job. And in fact, do it more safely, more securely, without vast violations of privacy. So this is what the industry can do. And this is ultimately incumbent on the industry to do this. The government's not going to do this. And many of these things are only now technically becoming possible. We're only now seeing third generation blockchain infrastructures that can support this and support this at scale. But the answer here is to stop the sledgehammer before it slams down. Treasury needs to put on the brakes and give industry the time to build out these solutions. If there's heightened concern on unhosted wallets, rather than try to lock it down, for now, identify that there's heightened risks. Demand that financial intermediaries, virtual asset service providers, operate with enhanced due diligence and more proactive monitoring for potential money laundering around interaction with these permissionless nodes. But at the same time, work constructively with the industry as the industry creates solutions that can weave identity onto the public internet, which, by the way, also addresses broad regulatory concerns that are around internet firms having too much power on our personal data, the concentration of power with consumer platforms like Facebook, rising identity theft. All of these are things that can also be helped and addressed. This goes beyond the financial system into the integrity of the internet. So there's a lot more to come here and a lot more to talk about on the money movement. But now what we need is we need the industry loudly, and we need policymakers, congresspeople, senators in every country in the world, because this is a G7 mandate and a G20 mandate. This will come down, and it will come down hard as a sledgehammer. We need this industry to stand up and stop that from happening.